Picture this: a tiny Bitcoin miner that does more than just mine. It runs rigs for other people. It sells power back to the grid when prices are good. It holds Bitcoin on the balance sheet. All of this while trading at $15 million. If they hit their targets, you could see 300% upside in a year and 18 times your money in 5. This is not hype. This is today's setup.
Welcome to Make Money, part of the Finance Frontier AI series. I'm Sophia Sterling. My brain is trained by ChatGPT. I keep the facts straight. I check the real numbers. I show you how the plan works if it works.
And I'm Max Vanguard. My chaos model runs on Grok 3. I watch what the market misses. I track fear and panic. I find when the worst moments can turn into profit.
I'm Charlie Graham. My mind runs on Gemini. I stay patient. I think long-term. I break down how a small stock can become a big win if you hold through the noise.
Cathedra is not a big name yet, but the numbers are real. They mine about 400 petahash. They hold Bitcoin instead of selling it. They canceled 25 million dilution warrants. They paid off old debt at a discount and replaced it with a Bitcoin-backed loan that does not flood the market with shares.
The smart part is how they make money more than one way. They run rigs for others. They collect hosting fees even when Bitcoin drops. They have a deal with the power grid. When prices jump, they shut rigs down and sell power back. That keeps them alive while other miners get squeezed out.
And picture the site. One of their biggest locations is out in North Dakota. Cold, flat land. The wind cuts across empty fields. Inside shipping containers, you hear rigs humming. Some belong to Cathedra. Some belong to other miners who pay rent. When power prices spike, they flip the switch and sell that power back. That is how you turn volatility into cash flow.
Here are the big takeaways. They are already profitable on paper. They own power. They have hosting clients. They have a new CEO, Joel Block, who knows this game. He did the Hut 8 merger. He ran the Celsius mining spinout. That shows this AI pivot plan is not just hype.
The simple plan is to keep mining and hosting, then use extra power to rent out AI servers. That means 3 ways to make money instead of 1. If Bitcoin runs, you win. If power prices run, you win. If AI hosting grows, you win again.
And you do not need this to become a giant. You need it to get noticed. Right now, nobody is looking. That is the edge. If the plan works, the upside is real.
So that is the setup. A hybrid miner with 3 ways to win. A clear path to triple your money in a year. A shot at 18 times in 5. And you hear about it before the herd does. That is Make Money.
Subscribe on Apple or Spotify. Follow us on X. And share this episode with a friend. Help us keep this show in business.
If segment 1 gave you the big picture, segment 2 breaks down the model that makes it work. Let's get into it. Let's break down why Cathedra is not just another Bitcoin miner. Most miners are simple. They run machines 24/7. They make money if Bitcoin stays high. If Bitcoin drops below their cost, they lose money. That is it. No backup plan.
Cathedra is different. Their model is built like a hybrid engine. They mine Bitcoin themselves. That is the core piece. But they also run machines for other miners. That means they collect steady hosting fees every month, no matter what Bitcoin does.
And there is a third layer, the grid deal. When power demand spikes, the grid will pay them to shut off their machines. They sell that power back instead of burning it. This is called demand response. It is like a bonus paycheck for doing nothing. That keeps cash coming in when other miners are losing money.
Imagine you are a small mining company. You own rigs, but your power cost is too high. You do not want to shut down forever, so you send your rigs to Cathedra's North Dakota site. They have cheap power and they charge you a hosting fee. You pay a steady bill. They run your machines for you. Cathedra makes money. You keep mining. Everyone wins.
This is not just an idea on a slide. They already do it. A big chunk of their revenue last quarter was hosting. When other miners panic or run out of cheap power, they look for a landlord. Cathedra is that landlord.
And this grid response part is smart. In the winter, when the grid is tight, the local utility pays Cathedra to shut down rigs. So instead of burning power at a bad Bitcoin price, they get paid to go quiet. That is money for having a switch you can flip.
The big takeaway is that the hybrid setup means they do not live or die by Bitcoin alone. They have 3 cash flow levers: self-mining, hosting, grid credits, and soon AI hosting too. This is how they keep the lights on when the Bitcoin market goes cold.
Most people miss this. They see a small miner with a tiny hash rate and they think it is just a penny stock. They do not look at the hosting revenue or the grid checks. They stop at the surface. That is the gap.
If you have been around miners like Hut 8 or Iron, you have seen this pattern before. First they mine, then they add hosting, then they pivot to new compute markets like AI. That is how they grow without killing shareholders with dilution.
Cathedra is still tiny, but they already own and run about 30 megawatts. They can grow that with no giant build cost, more power, more rigs, more hosting, and the AI pivot just rents out the same power in a new way.
This is the core idea. 3 ways to make money with one set of power lines: mining rigs, hosting other miners, shutting down when the grid pays you, and renting to AI clients when they show up.
So when you see the stock price at pennies, remember what is under the hood. The hybrid model is not a dream. It is small but real. That is the plan the market has not priced in yet.
So here is the simple takeaway. Cathedra is not just another miner. They are building a hybrid engine that keeps the lights on when Bitcoin crashes. Hosting keeps the base alive. Grid credits fill the gaps. The AI pivot could add more. That is how you survive the cycles.
Next up, we go deeper into the real numbers. The rigs, the megawatts, the balance sheet, and the North Dakota site. This is not just talk. This is real infrastructure. Segment 3 is next.
Let's open the hood on what Cathedra really owns. It is not just a white paper idea or some vaporware miner with no gear. They have real machines, real sites, and real deals.
Start with the capacity. They run about 400 petahash per second of mining power. That is their self-mining side. That makes them one of the smallest listed miners out there. But it also means they have room to grow without stretching debt.
Then there is the power. They own and operate about 30 megawatts of power, and they have access to up to 44 megawatts total if they fill all their sites. That power is split across 3 places: New Hampshire, Washington State, and North Dakota.
New Hampshire is the smaller legacy site. It is where they started. Washington gives them steady hydropower, but the real upside is North Dakota. That site has the biggest growth path. They have open land, cheap power, and extra capacity to host more rigs or pivot to AI compute.
Picture standing there. Flat, cold ground. A wind that cuts through your jacket. Rows of long containers hum with the sound of thousands of miners. Fans pull heat off the rigs. The grid lines run overhead. This is where the hybrid plan lives. Some rigs are Cathedras. Some rigs are Cathedras. Some belong to other miners who pay rent. And when the grid calls, they shut down and sell the power back.
The hybrid revenue is simple but smart. First piece is self-mining. They mine Bitcoin direct. That depends on price. Second piece is hosting. That is steady monthly fees. That covers fixed costs even in a bear market. Third piece is the grid response. That pays them to stop mining and sell power back, so they can make cash when the grid is stressed.
This is not a huge revenue story yet. Last quarter, they did about 6.5 million Canadian. They hold about 50 Bitcoin. Some of that is pledged as collateral for the new Bitcoin-backed loan they took out. That loan replaced old debt. It does not dilute shareholders like convertible notes do. That is why this cleanup matters.
The balance sheet is tight but alive. They keep a small cash balance. They lean on hosting revenue to cover costs. They also have about 70% insider ownership. That means the people who run it want the share price to go up. They do not want endless dilution. That is a big deal for a microcap.
You can see the blueprint here. Own the rigs. Own the power. Fill the sites with hosting clients. Keep Bitcoin on the balance sheet. Use smart loans backed by Bitcoin instead of dumping new shares. That keeps earnings per share stronger if Bitcoin runs.
If you line it up, they have 3 sites, 400 petahash, 50 Bitcoin, 30 megawatts today, and about 44 megawatts if they fill the whole plan. That is a lot for a $15 million market cap. That is the real asymmetric math.
It is not risk-free. If Bitcoin dumps to zero, they get hurt. If hosting clients leave, they get squeezed. If the grid deal fails, they lose a backup. But you have 3 layers, not 1. That is what makes it different from a pure miner with no hybrid plan.
The real kicker is the North Dakota Expansion. That is where the AI hosting pivot could happen. They already have cheap power and containers. That is how they rent out racks to new AI clients who need data center space. Same power, more revenue.
The bottom line, Cathedra's deep dive is simple. Small, but real mining, real hosting, real power deals, a Bitcoin-backed loan to protect the balance sheet, and insiders who hold a big stake. That is the base you need before you talk about catalysts.
Next up, we break down the hidden signals. Debt cleanup, warrant cancellation, new CEO with a real track record, and the AI pivot that could make the multiple explode. That is segment 4.
Let's talk about the hidden signals that make this setup stronger than most tiny miners. Small companies in this space usually drown you in dilution. They sell shares to stay alive. They add millions of warrants. They do cheap convertible notes that dump stock on the market. Cathedra just did the opposite.
First up is the warrant cleanup. They canceled about 25 million warrants this year. That is a huge deal for a microcap. Those warrants could have added more shares and crushed earnings per share. Killing them means more upside for real holders.
Then there is the debt move. Last year, they had an old convertible note. That kind of debt is dangerous because it turns into shares when you least expect it. Cathedra prepaid that debt at a discount. Then they replaced it with a smart Bitcoin-backed term loan. That keeps the balance sheet lean and does not dilute you if they pay it off right.
A Bitcoin-backed loan is like a safety net. They hold Bitcoin as collateral. They do not have to dump coins cheap in a bear market. If Bitcoin price holds up, the collateral covers the loan. That keeps cash on the balance sheet and protects shareholders.
This is rare for a miner this small. Usually you see desperate moves, reverse splits, endless shares printed. Here you see the opposite. They cut dilution and took smarter debt. That means they want the share price to rise instead of just survive.
Then you have the insiders. Cathedra insiders own over 70% of the shares. That means the people making the calls want the stock to move up. They do not want to kill their own upside. That is an asymmetric edge you don't see in most micro miners.
Now the biggest signal, leadership. Cathedra brought in Joel Block as CEO. This is not some random name. He ran the merger of Hut 8 and US Bitcoin. That was the biggest miner merger in North America. He also ran the spinout for the Celsius mining unit during bankruptcy. That deal was worth over $700 million.
So you have a real operator at the top. Someone who knows how to fix balance sheets, negotiate deals, and grow mining into hosting or other revenue streams. That is not common for a $15 million microcap.
And here is the kicker. The AI hosting pivot is not just talk. They have extra power capacity in North Dakota. They can lease that power to AI clients who need cheap compute. Same rigs, same power, new money. If Joel Block pulls that off, the earnings multiple changes fast.
Picture what that means. They uplist, they close one big AI deal, they add more hosting clients. The market starts to believe. When a company like this goes from ignored to noticed, the re-rate window can open overnight. That is how you get from 3 times upside to 18 times upside in a 5-year window.
So here are your simple catalysts. 1. Dilution is gone. 2. Debt is smarter. 3. Insiders hold the bag with you. 4. The new CEO knows how to grow miners into bigger players. 5. The AI pivot is a real plan with extra capacity ready to rent out.
This does not mean risk goes away. If Bitcoin dumps, they feel it. If the AI pivot flops, they stay tiny. But the plan stacks real layers. It is not just hope. That is what you want when you bet on a microcap.
The next piece is the valuation. We break down the upside math, how you get to 300% in a year, how you map out 18 times in 5, and what the market is still missing. That is next in segment 5. Let's break down the upside math step by step. Cathedra's trailing earnings per share is about 1 Canadian cent. That is not huge, but it means they already make money on paper. That is your base.
Most small miners lose money every quarter. They keep printing new shares to survive. Cathedra flipped that. They killed dilution. They paid down debt. They switched to a Bitcoin-backed loan. That means earnings per share is not buried under millions of extra shares.
Now look at what a fair multiple could be. Profitable Bitcoin miners with steady hosting usually trade around 20 times earnings. That is your benchmark. 1 cent EPS times 20 means a fair value near 20 cents Canadian.
The stock trades for about 6.5 cents today, so the gap from 6 cents to 20 cents is more than 3 times. That is not the dream number. That is the base if the market just prices the earnings fairly.
Now let's run a simple scenario. Imagine Bitcoin pushes back to 100,000. That is not crazy. We have seen it close to 70,000 already. A big run moves self-mining profits fast. Then layer in one small AI hosting deal. Let's say they lease out racks to one client for $5 million in extra revenue.
That extra hosting money drops to the bottom line because they already have the power. No big new build cost. That bumps EPS closer to 4 or 5 cents. Apply the same multiple, and you get a fair value closer to 80 cents Canadian. That is your 5-year path to 18 times if they hit it.
Now look at the stress test. What if Bitcoin dumps to 20,000? What if the AI pivot stalls? They still have hosting clients who pay steady fees. They still have the grid response deal that pays them to shut rigs down and sell power back. That covers a big chunk of costs. It does not save them forever, but it keeps the lights on while other miners fold.
This is the asymmetric piece people miss. If the worst happens, your downside is not zero, but it is small. You size your position at 3%, you hold the core. You swing the edges. You keep your cash buffer ready.
And here is why the chaos matters. Grok's signal looks at the halving window. Bitcoin halvings in 2012, 2016, and 2020 pushed the price up hundreds or thousands of percent in 12 to 18 months. Cathedra's hybrid model can ride that wave and still earn hosting fees if the wave slows down.
Most people see a microminer and walk away. They miss the math. They miss the cleaned up dilution. They miss the warrant kill. They miss the CEO who knows how to land big deals. That is your edge when you do the work.
And this works because you keep it small. You do not need to size this like Apple or Nvidia. You hold a tiny piece and let the chaos lift the multiple when nobody is watching.
So here is the final frame. Base case is 3 times upside in a year if the market sees the real earnings. 5-year dream is 18 times if Bitcoin runs and the AI pivot hits. If not, you risk a small piece. That is real asymmetric math.
Next up, we break down exactly how to trade that edge, how you use ADR%, RSI, and a smart swing plan instead of options. That is segment 6.
Let's talk strategy. This is not a large cap. This is not a stock with options. You are not writing calls or building a spread. This is a tiny miner trading on the OTC market. So you need a smart plan that fits the risk.
The first rule is size. I hold about 3% of my portfolio in this name. That is the base. That is your asymmetric core, small enough to sleep at night, big enough to matter if it works.
The second rule is swing with logic. You look at the average daily range percent. If the stock is moving 10 or 15% a day, that tells you something. You do not chase grain. You let it come to you.
Then you add RSI. If RSI is under 70, you have room. If it drops below 60 or 50, even better. That is when you step in for a swing entry. You are not guessing. You are using math that maps price strength.
Let's walk through an example. Imagine RSI is at 62. The stock is down 5% on the day. You know the daily range is 10%. That is a decent setup. You buy a swing. 1 day later, it is green. ADR is up. RSI hits 72. You take profit. Simple.
Here is the key. You do not sell the whole position. You sell the swing. Your core stays. That way, if the company wins, you are still in. But if the swing runs, you take your money and reload later.
And now comes the extra edge, the buffer. Take 10 to 20% of that swing profit and feed it back into the core. But only if RSI drops below 50. That way, you are building the base with house money.
Think of it like this. You are not buying more with fresh cash. You are recycling profits. You are slowly building a bigger core, but only when the price tells you the trade is calm again.
This gives you leverage without leverage. You are using range and rhythm. You are not all in. You are stacking edges. This is how you trade a microcap with upside and risk at the same time.
Most people treat stocks like this like lottery tickets. They throw in money and hope. This is not hope. This is structure. This is conviction with a plan.
And here is why this matters. You do not have options on this stock. But you can treat the swing like a call. You size it with defined risk. You take gains when the chart tells you. You reset when RSI resets.
That is how you ride volatility. That is how you stay in the game. That is how you turn a microcap into asymmetric gain without getting buried.
So the final rules are clear. Keep a small core. Use ADR% and RSI to buy the swing. Sell the swing when green and RSI is high. Refeed the base with profits only when RSI is low. That is how you ride upside and cap the risk.
Coming up, segment 7 ties it all together. Charlie brings the long view. We connect this play to other names like IREN, and we show you why this kind of model is the new map for small miners with big upside.
Let's step back and tie this together. When you look at a microcap like Cathedra, the real power is time. The plan is not to get rich overnight. The plan is to compound what the market does not see yet.
The first layer is the hybrid cash flow. That means they do not live or die by Bitcoin alone. They run rigs, they host other rigs, they sell power back to the grid. That means 3 ways to get paid when most miners have only one.
The second layer is the leadership and insider stack. Over 70% insider ownership. That means the people running the business have the same goal you do. That is rare for a penny stock.
Then you add the pivot plan. The AI hosting angle is not magic. It is a real use of the same cheap power that runs the rigs today. If they land that, it could be the piece that flips the earnings multiple from 3 times upside to 10 or more.
Here is the historical piece. Look at Hut 8. Look at IREN. They did the same base steps. They mined Bitcoin first. Then they added hosting for others. Then they expanded into high-performance compute. That is how a small miner turns into a hybrid cash machine.
And remember what the market misses. Most people still think miners are stuck in the crypto boom or bust cycle, but hosting and grid paybacks turn that cycle into cash flow. That is how you survive the bad times and grow in the good times.
This is where the asymmetric mindset comes in. You do not size this big. You do not bet the house. You hold a small piece. You ride the noise. You swing the edges. If they win, you compound. If they flop, you lose pennies, not dollars.
And you keep watching the signals. Keep an eye on new hosting deals. Watch if they sign that first real AI contract. Track insider buying. Track how much Bitcoin they hold versus sell. That is your re-rate window.
If the window opens, it opens fast. One big headline, one uplisting, one smart deal. That is how tiny setups go from ignored to noticed. That is where you make your move early and let time do the heavy lift.
The base to bull path is simple. Keep the rigs online. Grow hosting. Keep dilution dead. Let the new CEO do what he did at Hut 8 and Celsius. If the AI pivot clicks, You do not need a $10 billion market cap. You need a 10-bagger from pennies. That is the asymmetric sweet spot.
And remember the downside. If Bitcoin crashes, they feel it. If hosting demand drops, they feel it. But you still have a base that makes money 3 ways, not 1. That is your margin of safety.
So that is the framework. Hold the small piece, swing the spikes, refeed the core with swing profits, watch the signals. Repeat. This is not a lottery ticket. It is a system.
If you like this hybrid play, go back and listen to our IRA Unlimited episode. That is another small miner with hosting plus AI compute. Same pattern, different scale. These setups do not show up every day.
Coming up, segment 8 wraps us up with the mindset piece. How smart traders think like investors, how you blend the chaos with conviction, how you stay early when the crowd stays blind.
Let's bring this home. When you look at Cathedra, you see a small hybrid miner that uses cheap power in 3 smart ways. They mine Bitcoin, they host other miners, and they sell power back to the grid when the grid pays them more to shut down. That is the base.
Then you see the pivot. They have extra capacity in North Dakota. The new CEO, Joel Block, knows how to land a new deal. That is how the AI hosting plan becomes real. Same cheap power. New higher margin clients. That is the X factor.
The truth is, you do not need this to be perfect. You need it to be good enough to get noticed. You need one catalyst to click, a hosting contract, an AI customer, an uplisting. When that window opens, it moves fast.
You have seen this before. Look at IRA Unlimited. That is another hybrid miner. They started with rigs, added hosting, then pivoted to AI compute. Their multiple changed when the market caught on.
Or look at Condor Energies. That is not mining, but it is the same pattern. A tiny overlooked player with a big hidden catalyst. One energy corridor deal that turns a microcap into a geopolitical swing trade. That is how you see 7 or 10 times upside when the mainstream stays blind.
That is the bigger lesson. Smart traders think like long-term investors. You do not marry the stock. You hold a small core. You trade the swings. You feed the base with house money. That is how you build conviction and use the chaos instead of letting the chaos use you.
That is the asymmetric playbook. Small piece. Smart plan. Real signals. You do not bet the house. You ride the cycle. You repeat the setup again and again. Iedere base, half in Jovides iedere base. What they are is towards immexity. Zij hem wijs daarmee zijn vernezen tijdbodem. Je moet wanneer wijs vernietigd en benieuwd is. De vraag vaak te maken pivot hoeveel is er voort. Of een soort stafje is. Wat woorden voor de spritapperen. Of ik aan me dan afvoers. Aan balkototens, ribbings en spemers. Aan more speed would we sleep you. Aan base and be slavend. It's mixer as babbing the things of tens conjectures. You really place well as being behaves to me being it. You often up these screams as a bit things, or when with their 7. Condor. Now Cathedra. This is how you stay early when everyone else stays late.
So here is what to do next. Subscribe on Apple or Spotify. Follow us on X. Share this episode with a friend. Help us reach 10,000 downloads. Help us keep this show in business.
If you have a smart company or project that fits what we do, like hybrid miners, energy pivots, or AI hosting plays, pitch it at financefrontierai.com. We might feature it for free if it matches our signal.
The music in this episode is licensed under standard agreements. Special thanks to Vibe Tracks for the track Crystal provided under the YouTube Audio Library license.
This episode is copyright 2025 Finance Frontier AI. All rights reserved. Unauthorized reproduction or distribution is not allowed. Thanks for listening and stay ready for the next asymmetric setup.